Hi everyone, good morning. So today we are going to talk about unlevered beta, which is also known as asset beta. You do not need to be scared by the terminology. Beta is simply a measure of how sensitive something is to the movements in the overall market. We have discussed about beta in capital asset pricing model also and in the weighted average cost of capital thoroughly. I don't think that you need to be scared of beta anymore. So when a company has debt, its equity becomes riskier, and because of the reasons is that because debt actually increases financial pressure, and unlevered beta actually removes the effect of debt. And let us ask a very important question for unlevered beta for today's topic: how risky the company's underlying business is in itself, and if it's had no debt. So this means that whether or not the company's operations are able to finance themselves or not, or whether uh, they actually have to raise money to finance their operations. Okay, so why it's useful? Because companies' operations, which are majorly selling products and selling services, have a fundamental level of risk, and beta can distort the picture, or yes, distort the picture. Basically, the correct word would be distort the picture only. So unlevered beta actually helps us to compare companies on equal footing, uh, and regardless of how they are financed. So what we are going to discuss is that businesses face business risk, which is based on the nature of the industry. When they borrow money, they actually add financial risk, which is also known as the debt, because of the debt component of debt. And this actually makes equity more riskier for the equity holders, because when we talk about debt, so the debt holders are always going to get their interest payment. So debt holders are going to get their interest payments, and at the end of the tenure they are also going to get the principal amount. But the more we increase the debt component, so the if it works, it's better for uh, the equity holders or the debt holders, both for the whole firm. But if raising more debt doesn't works well, so it would be riskier for the equity holder, and that's why raising more debt actually increases the volatility. Because if you are not able to fund your uh, business using from your operations, and you are raising debt from outer sources, so ideally it should be that your company is not raising debt, and it's in itself able to fund itself from its operations. But when companies capital structure uh, involve debt, and because your debt is also raised, some part of debt, some debt is good, but more when we increase more debt, so the business gets riskier for the equity holders. And okay, so that's pretty much it about it. So in unlevered beta, when we are unlevering the beta, we are removing the effect of debt. So it actually removes the financial risk. So debt creates financial risk. Uh, Debt creates financial risk, and business risk is the risk of the business based on the nature, how revenue and margins move with the economy and the market. And financial risk, the extra volatility introduced by borrowing. So you need to remember this thing. And unlevered beta actually removes the financial, the debt portion. Unlevering means in itself, unlevering means that we are uh, removing the effect of lever. Lever means debt. So leverage is, when we are talking about leverage, we are basically talking about debt. So unlevering means removing debt. Removing debt means unlevering. Okay, so when why are we removing or why are we unlevering the beta? So let's assume there is this company. I had a snippet in the previous. Okay, let's assume it's Infosys. We are talking about Infosys. If you look here, the Infosys are reported beta 1.2. So this beta actually involves the financial risk. So you need to understand this thing that this is not equity risk, but it actually not equity, but it actually also involves financial risk. Equity risk, we can also say that business risk. So financial risk is because of debt. I'm assuming whatsoever, okay, in journal, whatsoever is the business model of Infosys. Let's not discuss about the business model right now. In journal, let's say XYZ is the business model. So there is some product and there is some services. That's pretty much a business does. So either they are going to produce or they are going to service. They are selling a product or they are offering a service basically. If they are working, if their business model is this much efficient that they are able to fund themselves, they are able to raise money to support their operations and grow itself organically by their product or services itself. So the beta it would have reported, it would have been considered a unlevered beta because there was no debt involved. But the company has actually raised debt because there may be n number of reasons, maybe because of the tax shield, uh, because of because actually debt actually helps to uh, increase the return on equity and n number of reasons, like I said. But the beta reported by the company on a internet platform, it represent this beta represent because of the capital structure, it represents debt plus equity, the risk involved in debt and equity. So we need to remove the debt portion, the risk because of debt, which we can, but we can get the equity risk, the beta because of the beta, not risk, but the beta of equity. Then we will compare it across those companies which are not listed, and then we calculate our then we relever the beta on the basis of the company of our interest. Okay, I hope this much is clear. Just the last part which we have discussed right now, we will discuss it in here, but here we will be doing it in a better way. There is a step-by-step process involved. So let's talk about the core formula, the core formula of deleveraging and leveraging. So the formula here, so deleveraging means removing the impact of debt, and releveraging means we are applying it to the new capital structure. So just understand the formula. Just look at the formula here. So this formula is for beta unleverage and beta leverage. So leverage involves debt which is reported by the company. And I have just shown you the example of Infosys. So we are using the beta leverage. We are using the capital structure of the company Infosys. Then we are calculating beta unleverage. We are unlevering it based on the capital structure of the company. Then we are relevering it based on the capital structure of new company, new capital structure. This is important. So capital structure here is different, and the capital structure which is used here, that's also different. We will be using this beta, uh, unlevered beta, to calculate our new beta. We will be taking the reference of this beta. Okay, so I hope this much is the core formula is clear to you guys. Beta leverage represent the observed beta, which is reported on the internet or any financial platform. Bloomberg, Capital IQ, uh, these are actually these are actually business to business platforms. These platforms sell business to business, not there, but you can also get these numbers on Yahoo Finance, or there are a lot too many more now. uh, Yahoo Finance is there. There is Money Control also. Money Control also releases these numbers, so you can get it there also. So beta unlevered is beta unlevered is also called the beta of the asset because we have removed the impact of debt. So levered beta means it has debt. This is we have removed the impact of debt. Debt to equity is the ratio market values, because used with by calculating the market values, we are calculating how much is the debt and how much is the equity, and we are getting a ratio out of 100%. How much is the debt and how much is the equity? Let's assume this is debt and let's assume this is equity. So when you are talking about debt to equity ratio, we are talking about this thing, debt to equity. And corporate taxes, yes, corporate taxes and effective taxes. There is a difference between corporate taxes and, okay, we will discuss about it later on. So the variant, uh, the basic formula, we assume that the debt is risk-free, but this is not always the case. So debt is not risk-free always. And a more general relationship would be for unlevered beta, for leverage beta, which was the formula here, is we need to subtract the beta involved because of debt. So you do not need to memorize this, just understand if debt is risky, you must account for its beta also. Don't memorize this thing. Once you will start practicing these kind of things, so you will grasp the concept. Okay, let's do a question. Let's do an example. Uh, Not example, but let's understand step by step how analysts typically estimate a beta, unlevered beta. So this is a simpler case. The first one, which is the direct method. So this is actually a simpler case. If a company is publicly traded, we often have a levered beta, which is already available from any financial platform. By running regression analysis. But for running regression analysis, you will be needing the data of the stock, or um, the data of the stock and the market index which you are comparing it to. So the step is, first you get the levered beta, then you get the market values of the equity and the debt. If you are able to calculate the market cap of the equity and the market value of debt, it's okay. But if you don't know, if you are not able to calculate, then you use proxies, the best proxies. You assume those numbers. Then you use an effective corporate tax, which is important to calculate the tax shield. And then you apply in the unlevering formula, and you get the beta unlevered. And this is the simpler approach, but the pure play method, which is used in practice or in private firms, this is actually more important to understand. And there is nothing difficult about it, trust me. So, okay, first thing, here is where it gets interesting when we are where the experts are valuing. So it actually involves a lot of time, and this is actually how the experts or the valuation experts spend their time. And if a firm is private, it has no stock. Think about it. If a firm is private, it does not have any stock price. So we cannot directly observe the beta. So the solution here is to find the publicly traded peer company and borrow their data. So I'm assuming that I have a company ABC, and this is a private entity, and there are two companies, XYZ and PQR, which are being traded which are publicly listed companies. So what I will do is I will borrow the companies' data to do my analysis. So first of all, I will select 4 to 10 companies of such kind which have the same business model as mine, or the same business model of the private company, similar business risk. Then we find each company's levered beta, which will be basically published, or we can do a regression analysis. We will talk about regression analysis uh, maybe after a few videos. After a few episodes, I will try to make a video of regression analysis, a quick and shorter video, so that you can get uh, an idea of how regression analysis is done using data. Then we'll unlever each peer's beta using the debt to equity ratio and the tax rate. So we will unlever each comparable beta using using their debt to equity ratio. So we will be using debt to equity ratio of them only. Once we have done this, we have unlevered beta, we have unlevered beta 1, we have unlevered beta 2, we would be having unlevered beta 3, and unlevered beta, let's assume 10 to 15, 4 to 10 companies. Let's assume we have done 10 companies. So we have 10 unlevered beta, then we will take an average of all these beta. We will take an average of all these beta, and this will be the industry beta asset. And why would be this industry beta asset? Understand this thing. So even though 4 to 10 companies would not be the correct word to call it industry asset beta, average industry, because to look at a sample size, we need 30 companies. The 30 is the ideal sample size. Just remember this thing. Sample size as per statistics. So just for reference, just for to understanding, we are calling it industry beta because this average is pretty much representing what the industry average is. So that's why we are calling it industry asset beta. And if you are valuing a specific firm, then you relever this industry, relever. Now we have unlevered, and now we are going to relever. Relever based on this company's. Let me just do a different color. Uh, then we will be using this company's debt to equity ratio, capital structure, to relever our beta. So this time the debt to equity ratio would be different. This debt to equity ratio would be different. Let's assume this is going to be, not assume that this is going to be the private company which we were talking about. And these on all the beta unlevered 1 to beta unlevered 10. So we will be using debt to equity ratio of company 1, debt to equity ratio of company 2, debt to equity ratio of company 3, and just like that, debt to equity ratio of company number 10. So don't get confused here. Don't never mix up things when you are doing a valuation, or when you are doing beta calculations. not just beta, but any calculation of complex nature. So I hope this much is clear. And let's talk about the practical details and the rules of thumbs. So, okay, so we are going to use the market values of debt and equity when possible. Market values, market values of debt and equity. For market value of equity, share price into current share price into number of shares outstanding. Pardon my language, pardon my handwriting here. Uh, uh, Capitalization equity and for debt. For debt, we are going to use the market values. Market value of debt, not the book value of debt. Just remember this thing, market value is preferred. Equity is calculated using current share price. Current share price, we multiply it with shares outstanding. Do not use the book values. Companies do report out the book value numbers also, but we are going to use market value numbers whensoever we are doing valuation. Tax rate should reflect reality and not as statutory tax rates. Statutory tax rates are internal rates, and these effective or expected tax rates are actually those tax rates the company actually pays to the government. We need to adjust for excess cash also. So the third detail is that the practical detail or the rule of thumb is that we adjust for excess cash. Cash. The why this is done because cash has almost zero beta and it actually lowers the real business risk. So typically, cash has lower beta and reduces the business risk of core operations. Debt beta matters because when evaluating firms with risky or high yield debt, we need to consider the beta of the debt also. So you cannot assume that debt is risk free. If debt is risky, incorporate a non-zero beta of debt in the formula. And most practitioners do assume beta of debt is zero for investment grade debt, but this is an assumption only, not a law. So assumption, if you're assuming something, there is a 99% chance that you are going to be wrong. So always make scenarios. That's why it's an assumption, not a law. And if you're forecasting the future, I mean, uh, uh, if you are forecasting the future, there's a 100% probability that you are going to be wrong about it. So that's why always do scenarios. The what if scenarios. What if? Because future is unpredictable. Mm, okay, so let's move now next to the next point, choices of comparables. So you need to choose your comparables very wisely. Similar operations matter more than the industry labels. Uh, firms pick out firms pick that match operating characteristics and not industry labels, where the margins, cyclicality, and the product mix is same rather than the industry labels. Adjust the bottom-up leveraged unlevered beta for observable differences, operating leverage, geographical risk, and all. And regression betas are noisy. This means that these are sensitive to the time frame. So if you do a 2 years regression beta or a 5 years regression beta, both of these are going to give you different results of beta. And also the frequency of data you have taken, whether it's weekly or monthly, that will also produce a different result. that is also produce that is also going to produce a different result. So the time window and the frequency also matters. So this regression betas are a kind of noisy, but you should know how to calculate regression beta, and this will be helpful in your what if scenarios. All right, so let's do one question where we will be testing our formulas. So once we test our, once we do a question, so we will be able to better grasp the formula, which we have just discussed, unlevering and the relevering of the beta. I'm not getting into detail of how this formula is calculated because yes, we can do that, how this formula is calculated, but it's going to be of no use to you. In valuation, we will not be calculating the formula, but you should know the how to use this formula. So okay, let's discuss about the numerical example. So this is the beta leveraged is 1.5. This is the debt to equity ratio, which is 0.4. Okay. Corporate tax rate is 0.25. This means 1 minus 0.25 is 0.75. To compute the beta unlevered beta, we will plug in the numbers in the formula 0.75, debt to equity ratio 0.4. And once we calculate it, the beta unlevered will be equal to approximately 1.154. So since we have calculated beta unlevered, and we will not be able to calculate beta unlevered unless we have the debt to equity ratio, the capital structure of the company. We will not be able to calculate the beta unlevered if we did not had the tax rate. So these are the two important plugins. This is reported or this is calculated using regression or Bloomberg. Bloomberg. If you have access to Bloomberg, if you have access to Yahoo Finance, or if you have access to any other uh, financial platform, FactSet is there. There is Capital IQ, and many more. Morningstar is also there, and others. Or you can use the money control also, since we are talking about it. So we have calculated beta unlevered beta for one company. So, so previously when we discussed about uh, the pure play method, we were doing we were calculating the beta for 40 companies, beta unlevered for 10 companies, sorry. So just process this doing for 10 more companies, 10 more companies, and then you will be averaging them, and that then you will be using a beta, the beta average. So okay, then we relever and then we relever the beta. So beta levered is beta unlevered into this thing. So beta levered will be equal to beta unlevered, which was 1.154, And if we multiplied 1 by 1.3, we will again get our levered beta of 1.5. This means the math, we have calculated it correctly. And more importantly, you can now see the mechanics behind the formula. So how we are levering the beta when we how we are unlevering the beta. So this 1300 is calculated using this. Now let's talk about the bottom-up beta approach. So suppose you have five comparable companies with levered beta of 1.8, 1.6, 1.2, 1.41. So what you are going to do is you are going to take the median of the unlevered beta, and that would be your industry beta. Then you are going to relever it to your target firm's capital structure. For example, let's assume the debt to equity ratio of your target firm is 0.2 and the tax rate is 0.25. So you will relever the industry beta to get the beta, unlevered beta, industry unlevered beta, and you will get the industry levered beta. Specific to the new, this will be the new beta, new levered beta. Okay, so since we have discussed about this thing in detail, let's talk about the common pitfalls and how to avoid them. So, analysts make common mistake, and we should avoid these mistakes. First thing is that never use the book values of equity or debt. And why? Because book value numbers can bias beta adjustments. So that's why we prefer market values, the real market scenarios, because valuation is actually a real market thing. If market debt values are unavailable, document the approximation. Okay, so second point is that don't ignore cash because it actually reduces the business risk. Cash actually lowers the business risk, either moves excess cash before computing enterprise metric or adjust beta levered accordingly. The third point here is don't rely on single comparable. Over reliance on a single comparable or on highly leveraged peers. Always use a median for a reasonable peer set and check sensitivity always. Your peers should be reasonable. Don't assume debt is risk free for risky firms and ne- don't trust noisy regression betas blindly because uh, they are sensitive to the beta is sensitive to data frequency and the time frame. Beta is sensitive to these two things. So don't over rely on beta. Just remember this thing. Okay. So when to use unlevered beta, and this is a practical case, a practical use case. So unlevered beta is a core input in valuation, and we use it when comparing business risk between firms with different capital structure, uh, valuing private companies also. When we are valuing a private companies, so in private companies, since we have talked about it, there is no market beta, and we take public company, take public comps, unlevered their beta, relevered to private firms capital structure. We have discussed about it, and this is actually how you relever value a private company. Understand this thing. You might be saying that a lot of startups have different. I mean, a lot of startups which are not even listed, they have their valuation released. So this is how actually how venture capitals or private equity firms do their valuation using the comparables. But the early stage, the early stage investors, the early stage venture capital, the seed stage venture capitals or private equity firms, they actually use a different method of valuation. We will talk about it when we will be working on the valuation theory. When we will be doing valuation of startups also. So this is actually, but this company, when you're valuing a private company, just remember when you're using the market comparable data, this company which you are valuing, the private company should have a history of finances. And private companies do not have any regulatory requirements to release their financials, but they should have a considerable or a visible a visibility in the market. Okay. And when do we use unlevered beta? The last thing is DCF and WACC calculations. So for performing DCF and WACC calculations and modeling of cost of equity consistently with the target capital structure, so we use unlevered beta. And a short checklist. Uh, then to wrap up, however you compute a beta of, so howsoever, and whensoever you compute a beta for a valuation model, just follow this checklist that you have used the market values, market versus book values. You have used the market values. You have picked 4 to 10 peer companies, and those should be ideal companies with similar business model, similar products, and similar sizes. You have collect their levered beta. Uh, you have used the unlevered formula. You have unlevered their beta. You have adjusted for cash or major differences in their operations. You need to adjust for cash. Why? Because cash actually lowers your business risk. Just remember this thing. Adjust for cash. This is important. You need to adjust for cash. You relever for your firm's debt to equity, and you document all the assumptions clearly. And since we are talking about this point, cash, companies do keep cash in their balance sheet. Even Berkshire Hathaway, Warren Buffett's company, has a considerable amount of cash in their balance sheet. Why? You answer me in the comment section. So, what do you make out of it? Right. So, that will be it for today's session. So unlevered beta helps us to separate a businesses from financial risk, and it allows analysts to compare companies fairly and build more accurate valuation models. While the formula may look intimidating in its difficulty, yes, I understand that it's intimidating at first, but they all follow the simple logic. You remove the effect of debt, you understand the core business risk, you reapply debt if needed. And once you master this, you will actually you will be unlocking one of the foundational building block of modern finance. And all the very best for all the very best with your leverage when you are calculating the leverage and leveraging and applying these concepts. So thank you for today's session. My name is Deepak Best, and I will see you in the next episode.